You're listening to Lender Lounge with Kevin Kim, a podcast dedicated to the private lending industry. I'm Kevin Kim, and my goal is to sit down with key figures in the private lending industry to talk about their business and their personal lives. We'll get their takes on market conditions, the industry at large, and their personal stories. Overall, I really want to learn more about how they started and grew their businesses. So whether you're a lender, a borrower, a vendor, an investor, or anyone just interested in learning more about private lending, this podcast is definitely for you. Thanks for tuning in and enjoy this week's episode of Lender Lounge with Kevin Kim. Before we move on, I really want to tell you about a great sponsor that's joined us for the show. Spiegel Accountancy is a professional CPA firm with robust tax and audit practices. They have over 20 years experience in private lending and hundreds of clients in the space. I consider Jeff and his team at Spiegel to be an industry-leading CPA firm. They truly understand the tax and audit needs of private lenders. We share several clients of all shapes and sizes. They have over 100 private lending clients across the United States, several of whom manage hundreds of millions of dollars in their funds. As a trusted CPA, Spiegel ensures their clients' financial reporting meets the highest standards. For more information, visit their website at spiegel.cpa. That's SPIEGEL.CPA. Spiegel Accountancy, your strategic and innovative accounting partner. Hey everyone, before we jump into this week's episode, I have a little giveaway contest I want you all to participate in. From January 23rd to February 27th, 2023, we're going to give away a pair of AirPods if you enter to win via the Apple Podcast app. How do you enter to win? You leave a review and you also leave us a 5-star rating. We'll enter you automatically and you'll be entered to win this pair of Apple AirPods. So please join us in this little giveaway contest. We hope to hear from you. Thank you very much. Hey guys, Kevin Kim coming to you with another episode of Lender Lounge. Today, we are interviewing an esteemed colleague and someone I very much look up to, Mr. Ben Fertig. Ben, please introduce yourself to our audience and tell us a little bit about what you do in the company you were with.
First of all, Happy New Year, Kev. Good to connect with you again. Ben Fertig, serve as the president of Constructive Capital. Constructive Capital is a capital provider to our esteemed client base. We work in two primary residential investor asset classes, probably best known for our DSCR platform, but we're also active in the residential transitional classes, fix and flip, ground up construction, bridge financing. But it's a client first focused platform, and that's what we spend a lot of our time thinking about.
And just so our audience understands the business model, so when you're saying your clients, right, you guys are primarily capital providers in the context of, are you working as, is Constructive more of a kind of like an aggregator, or are they kind of working directly with brokers? What's the usual role it plays in the marketplace?
Yeah, so the majority of our concentration comes through a table funding model. So we fund on behalf of our client base, and coincidentally, we've just rolled out a correspondent program. Actually, in the RTL classes, we brought on somebody who's fairly well known in the industry, Rob Kang, formerly with Torak and Pier Street. And, Rob has incepted a correspondent business for us in the RTL classes. So, but relative to DSCR and still a lot of what we're doing on the RTL side, we're table funding on behalf of our clients. And that's got a couple of different variances. I mean, whether, we close the loan into, an agnostic trust, or we close a loan in the name of our client, can vary. But, effectively we're providing those funds at the table. So, we can effectively mitigate the balance sheet risk for our client base on the DSCR classes, which, as you know, have been volatile, to say the least, this year.
Say the least. It's been a wild ride last year and continues to be. And I feel like our space has gotten kind of a crash course in volatility in the past few years. One of the things that our listeners, and actually myself, is I don't know that much about the history of Constructive. Like, you guys came on the scene.
Yeah.
I think you guys came on the scene about 4 or 5 years ago. And we've been very close ever since, and we see at all the events, and you're a valued client of the law firm. But like, we don't know as much about the history of like, how did Constructive come to be and all that kind of stuff. So let's get into that a little bit.
In September of 22, I celebrated, is probably not the right word, but realized my 26th year anniversary when it comes to mortgage banking. The last 12 or so of those, we'll call it the end of 2012, early 13, have been exclusively in the residential investor loan market. That came through the inception of a company that was Jordan Capital Finance. It was actually named something else for a minute before that. And then that Jordan Capital Finance, 2012, 2013 was about the time that this industry started to attract institutional capital on any type of scale. If you remember, so when we got into the business, we actually had a repo facility with Wells Fargo. They also had one with Genesis at the time, and then ultimately with Blackstone through B2R. Right, but that was kind of the first capital, on an institutional basis that was matriculating in. And then, around the same time, you saw Auction.com become Colony, which ultimately became CoreVest, right? That was all about that time. And actually, Jordan Capital was a platform that we sold it. We did 2 mergers and acquisitions with it. The second time, it was purchased by Blackstone and merged with B2R, which ultimately became Finance America Commercial. That was February of 17. And, look, I was part of the executive team there, enjoyed it, and just kind of happened to hook up coincidentally with some of the partners at Fay Financial, who, owned the second largest at the time. Now they're the largest. They were the specialty servicer of residential assets. And just kind of hit it off with those guys. I played hockey in college. Their executive team was, there was definitely an athlete DNA there. And, it was just relatable to me. So, they were looking to add a business purpose lender to their platform. So we incepted that in the fourth quarter of 17, actually, and made the first loan in 18. It was me and one other person out of a basement office that Fay had, and probably did several $1 million the first month just with your people.
That was just like direct origination yourselves, or was it still the same business model?
Yeah, it was. No, I think it was direct. It was direct origination back then, right? And I think the big iteration that that I know that you're familiar with, and anybody who goes to conferences is familiar with, that in early 2018 is when Alex Offit joined, and Alex really drove 2 initiatives. One was he really only wanted to do third-party business. And he really, really gravitated towards DSCR loans, which at the time, relative to, what origination populations looked like, right? It was a smaller concentration. I always say it's because he was lazy and he didn't want to do the work that it took to do an RTL to direct borrower, but that's not exactly the case. So, but it was efficient, right? And I mean, in that, just kind of iteratively, we continued to go down that path. And, over the 5 years that we've been in existence, right? I mean, we certainly are, doing well into the nine figures, and in what's heavily concentrated towards the DSCR as far as our population, still the case.
Mm-hmm.
And it's actually one of the things that we're looking to do is diversify a little bit, just relative to, what we think a healthy concentration is between RTL and DSCR. So we've been here 5 years. The DSCR business has made us a good loan doc client, I think. We still are kind of sticking around that $240,000 average loan amount. So we do a lot of units, and that's always kind of been the model. And going into this year, we're not going to change that model that much. We're going to supplement it. We did bring on some things that we're excited about on the technology side, and we are going to diversify into this correspondent business, which I think kills two birds with one stone when it comes to diversification. We'll diversify the funding channels, the distribution channels, and I think we'll be able to diversify the product mix also at the same time. So we're excited about that. But I'd say that since 2018, we've just kind of continuously built this third-party DSCR business, and I think that most anybody who's familiar with us probably knows us for that.
Yeah, I mean that's you guys certainly cemented your reputation through all the crazy times the past 2 years, and really proven to be quite a valuable provider when it comes to that product. And I've had many conversations with Rob and Alex and over the years, but from a historical standpoint, the life cycle is remarkably short, comparatively speaking, but also quite resilient. Can you comment on that? Because one of the things that I've noticed with Constructive was, when things, pardon my French, but when shit hit the fan in 21, when shit hit the fan this past year, you guys really really were quite resilient, and I was really impressed by that. And we had private conversations about it, and you've commented on it at conference panels, but one of the things that we don't really get to know more about is what you were thinking about as the president of the company during these crises, right? The 21 crisis of COVID, 22 crisis of the rate hikes. Like, what was going through your head in preparation and execution through all that?
No, that's a good point. And I think that, one of the things that we did, and our word of the year for 2021 was diversification, and our word of the year for 2022 was also diversification. And look, and that extended to, what our liquidity, sources looked like. It extended to, we didn't do a great job with the product mix, because we're still very heavily weighted towards DSCR. And then we wanted to, just kind of, add to our distribution, our distribution channels. But, and I talked about this extremely early on, and I can remember being on some panels with Nima, just saying, hey, look, we diversified, through a direct life insurance partner when securitization was, the dominant provider of capital in the market, right? And look, you go back to 2021, I mean, the securitization bid was far more efficacious than any insurance bid will ever be, right? I mean, insurance, you've got to aggregate $50 million before you can trade it. You've got to, in most cases, realize some of the economics, through the servicing right, not necessarily just through a premium, right? And I think that, that at the time created a barrier to entry on some level, but the same time, while insurance money is rate sensitive, right, it's not as directly correlated to some of the disruption we've seen in the credit markets, right? So we've seen spread related assets get crushed and all those things, and insurance is less sensitive to that. So we started to diversify early in 2021. And Tom Haida from your firm did the MLPA for us with the insurance provider. I won't name them, but everybody knows who they are if I would. And at the time, look, everybody was making a ton of money in 2021, relatively speaking. We made a little less on some of those trades, but we got them engaged. And, it was, I think, as we looked at what would create the best path to sustainability for the business, is you saw what happened to securitization markets in March of 20, right? That was the COVID, that was obviously the COVID occurrence. And look, I was in the markets back in 2008, 2009, right, during the global financial crisis, and the same thing. It was just, it just ceased, right, to operate.
Right. That raises a question, though, because at 21, you're right? There was so much room for profit if you went toward the securitization route, and it must have been quite the challenge internally to actually conclude that, hey, we got to kind of bite the bullet here because of future risk. Like, how did that iterative process go, and how did you must have gotten pushback?
So everybody, look, we diversified. I mean, I think that, I think the market, the market's perspective was generally that we did really well with that. But, that was a result of kind of getting our ass handed to us in March of 2020, right? Where we were dependent on the securitization market. So when everything stopped there, and, we got this reputation for continuing to lend through it, and we really effectively didn't. I mean, we made some loans that the liability of not making the loan was probably greater than the liability of making the loan at the time. But we weren't really out there looking for business during that. And then, we talked to an insurance company, and they said, look, we would have bought loans through this, but we're not going to do our first trade in the middle of a global pandemic, right? I mean, now, if we had a relationship that was established, and we got the sense that they were genuine, and said, look, we've got to give up, a little economics, to effectively, in the name of diversification. And I mean, it was well worth the investment. I mean, it wasn't like we weren't making plenty of money in 2021, like everybody else was. So yeah, we did a little planning. I think I had started talking about it probably in the first quarter of 21, that, hey, this is the direction we were taking. Why some others didn't necessarily take that direction, I can't speak for. But now you've kind of seen some aggregators that are well known in the space, and you would know them. They have kind of brought insurance money. They've kind of liaised it to the market a little bit, and they've done it with a really good price. So, there's others that have it indirectly. We have a relationship with them also. So you've kind of seen that everybody's kind of recognized that was the way to go. But we did get ahead of it. And there was a time where, things were kind of, going batty, that we were able to operate, consistently, and, we were definitely a price leader. I don't know if we were the lowest price out there, but we were definitely a price leader. And it made a big impact. I mean, we this is the year, I call it the year of the inversion. We ended up, we were up 70% year over year in volume, and we were down 70% in net profit versus in 2021, right? Which is just kind of the times. But, look, you look at it, it served us well, through the first 3 quarters of this year. And then, the market found a way to catch up, albeit indirectly. We'll figure something else out to continue to, differentiate ourselves and add value to our clients.
And I have appreciated the thinking through that, because when you were discussing it, we had been talking about, we've been talking about internally over here, because we were always scratching our head as to, like, where is the life money? Where is life money? Because we also have commercial clients in the commercial sector. They jumped in years and years and years ago. And,
right.
And it felt like this was the right time for it to happen. And then lo and behold, in 22, in late 21, we saw a lot of it happening. And today it's kind of now standardized. So, but what's been fascinating is, this industry has had so much ups and downs, through from 20 onward and going into 23. And what are your thoughts about what are you guys preparing for 23, and where are you guys headed for 23? Because this is a year of, let's kind of see how it goes. I feel, at least, right?
We don't know. We don't know, right? I mean, and I think that, one of the things that you plan for is the fact that you don't know, and you better be ready to iterate. You better be ready to pivot. You better be agile. I think that, we can both, look at what you would do intellectually to prepare for this, right? You want to stay diversified. You want to have look, I don't know what the securitization market's going to do. I mean, there was a deal that just got done, actually, though. It was done by OBX, who is a subsidiary or affiliate of Annaly, the REIT. And that was an IQM deal. It was it was oversubscribed. The 3A, spreads were under 200. And that's the kind of stuff, the oversubscribed. I mean, you didn't hear that, since 2021. So I'm not sure exactly what's going to happen with the market conditions. And and obviously we don't have any control over that. I will tell you that we have found a way to use our forward commitment with the Life Co. To provide some value on the credit side as boxes are tightening out there. And that is something that we really designed based on client feedback, that there were opportunities that they just couldn't get to anymore. And what's been interesting is that hasn't been that price sensitive. I mean, we're running, over an 8.25 whack on that business. So I think it's just kind of those types of things. You just kind of have to keep on listening to, your stakeholders, and you kind of have to make decisions as they come. Because if you try to plan 2023 on an Excel spreadsheet, you're wasting your time.
It's too much, there's too much room for error there. No way to know.
Right. I mean, I think it was encouraging. It was encouraging to see. It's encouraging to see a deal, get done that there was actually some demand for. Well, look, as I mean, there's definitely a divergence in what the Fed is saying, versus what the market's saying interest rates are going to do. So somebody's going to have to be right, and we'll see what happens. I think the rate landscape will play a big part in this. But, I'm not sure that we've seen the full impact of the fact that, the borrower base, the, investor base, the capital markets and investor base, right, has fully digested the fact that, at some point in most of these transactions, the, calculus, right, of looking at the risk related to whether it's DSCR or RTL, through a 3% conventional mortgage rate lens to now a 6.5% conventional mortgage rate. I'm not sure that that's been fully integrated yet.
Yeah.
And we'll see if how priced in it is and how much of that still needs to be discounted into 23, right? But I mean, I think, that's, the impact of that recalibration, I think, is also going to be critical, especially on the credit side.
It's one of those weird feelings to enter into a year of uncertainty, but I feel like we've been through a lot of the past few years, so I think we can make it through.
So what is Lightning Docs exactly? Well, Lightning Docs is the gold standard in document automation software for producing business purpose loan documents all over the country. Whether you're working on a short-term fix and flip or a 30-year rental loan, Lightning Docs has you covered in all 50 states. Our staff here at Gerasi is constantly working to ensure that Lightning Docs is kept current with all the ever-changing laws and regulations, so you never have to worry about your document set being outdated or providing you with inadequate protection. Our goal here at the firm is to provide our clients with peace of mind, which means that we're always working to provide you with the best and most streamlined user experience possible. Whether that means getting you set up to pair Lightning Docs with your LOS system, setting defaults in our interview, or just changing some of the language in our document set, our staff is always ready and willing to help you with whatever you may need. Whether you're a private lender, a broker, bank, credit union, title company, you name it, Lightning Docs is the solution to all your loan document needs. For more information, please go to www.lightningdocs.com.
Now, Ben, I want to pivot a little bit and kind of ask a little bit about you, because, a lot of the industry have seen you participate at various different panels and things like that, and talk about the market and talk about capital markets and those kind of features like we just did. But a lot of the industry don't really know that much about Ben. You mentioned earlier you played hockey in college, and did you get into this space right away, or how did you land in?
No, so
this is a niche industry.
So back in '96, I came out of the University of Minnesota, and I tried to play professionally for about 8 days. And it was quickly realized that, not to overuse the word pivot, but it needed to happen fast. And so I went back to I was living in Minneapolis at the time, so I went back to Minneapolis, and I started applying for jobs, mostly finance related jobs, right? I applied at Nicholas Applegate, who was a boutique investment advisor at the time. The finance department at Caterpillar, jobs like that. And, you would go through this process. You could tell that you would send a resume in, it would get looked at. And then, you might get a call, you might not. That's just kind of how it was in the 90s, right? And so I send my resume to this place that I must have seen an ad for, and I get a call back in like 5 minutes. And it was the branch manager of some mortgage company. Mm-hmm. I don't know what a mortgage is really, right? I mean, so anyways, I go in for this interview, and I like the guy, right? I mean, I think this is in Bloomington, Minnesota. Mm-hmm. And, we're kind of just kind of going through, I would say, a typical interview. And, at the end of the interview, he says, because we talked about where I had applied and what my interests were. And he says, you applied for all these financially related jobs. He's like, why the psychology major? And I just looked at the guy and I said, I was like, it was the major at the University of Minnesota with the best looking girls. And he said, I'd like to extend you an offer of employment. So that was how I got in. That was in '96. I went into management 9 months later, maybe. I mean, that's just kind of how it was back then, right? I mean, if you were a good loan officer, the non-agency market, the subprime market at the time was growing so fast that, you'd go into management if you were a good salesperson generally.
Mm-hmm.
And so, all but 9 months or so of my career has been in management, which is probably why I'm so angry all the time. But I mean, and then interestingly, there was a crisis in the late 90s that was related to prepay speeds of these subprime loans. Because these programs would come out and somebody come up with an 80% cash out, and then the next year they'd come up with an 85% cash out, right? The capital markets were just kind of moving along as data was being collected. It was fairly new at the time. And, so that was like almost like a disruption like we've seen I mean, it stopped, and then rates were like recalibrated 200 basis points higher. But, when you're that new, you don't know what the hell is going on.
Right.
So from there, I just continued I left that job in 2001, stayed with another firm through the crisis.
Similar kind of firm, like a mortgage shop?
Yeah. Well, third party wholesale, mortgage banker based out of Houston. And then, we were nationwide,
Mm-hmm.
fairly large. And, and then I connected with Mark Filler in, the end of 2012, and Mark had, started Prism Mortgage and Prospect Mortgage. And he had, realized some unbelievable exits for those businesses and done really well. He still, invests in some businesses in this space, but, so we started Jordan Capital, from scratch. I think, admittedly, Mark would tell you he's a high level guy, has a great executive overview, but really kind of needed somebody to run the day-to-day of the business. And,
right.
Effectively, that's what I did. And we did 2 mergers, with Jordan Capital, the last of which was the Blackstone. And after that, I ended up, founding Constructive, with my partners at the time. And we've actually taken on another partner into Constructive, a REIT. So look, I mean, a lot of what I've done here is really tried to build a sustainable platform, right? I mean, I think we've got, 2 well-capitalized ownership groups. We've diversified our liquidity. So we've done a lot to, create what we think is a stable environment. And, the one thing that I think is lacking that we haven't done a good job of is to really kind of build the RTL business, because I think the RTL business has got, which, by the way, I mean, that was Jordan Capital's DNA. It's not like we don't have a lot of experience as a management team with it.
Right.
But I think that if you look at, how that structure generally works, you're either keeping it on balance sheet or you're collecting some type of a residual strip, which I think is, the next piece of the puzzle, that we need to focus on. And I think that's why I'm excited about, the correspondent business and seeing what we can build that into.
And that's a very interesting kind of, I wanted to ask a question about that, because today in our space and industry, you're quite well known for having a good insight into institutional capital markets and its role and its impact on the industry, and you had and on your business and a lot of those aspects of it. But and over your career, like where did you pick that up? Because with Jordan, you said you were kind of the day-to-day guy running everything, and Mark was the executive oversight, and previously you were managing a wholesale mortgage bank, and so there's a lot of different hats you have to wear, and I'm sure capital markets was part of it, but you didn't come from Wall Street. A lot of these guys a lot of our colleagues in the space kind of came from that world, right? And so, like,
Correct.
where did you pick this stuff up, and how did you gain so much mastery over it?
A lot of it was, so when I started, right, I mean, when I first went into management, I was telling you, there was a crisis that kind of came up right then and there relative to, the securitizations in subprime at the time were, it was fairly new back in the mid to late 90s. One of the things was just that you felt the impacts of it. So you needed to, you kind of organically got an understanding of it. But there was also a level of, when you started to get into, through becoming a branch manager to an area manager, look, if you had a troubled loan there, you needed to help sell it. You needed to determine, if you needed to go back and get extra documentation, right? And, the other thing is that the economics, relative to, and I've always basically been on some type of a P&L or arrangement that directly tied me to profit. You need to understand what's going on out there. Now, I will say that when I went to the wholesale banker, that was really autonomous. Where I was a regional vice president over 8 states, and we were effectively doing our own trading. So you were carving where loans went because you were really originating them to some type of investor specific target, right? So if I need
that opportunity to give you direct communication with with
direct
trading desks,
direct communication relative to the delivery, relative to price, relative to the impact of the end user who was the bond buyer and the securitization had. We actually did an asset-backed security there too, or a couple of them. I think it was, a lot of that was organic. And then, when I got to Jordan Capital, I mean, it just kind of was, look, nobody really understood how institutional capital was going to work in this space.
Right.
But, you were learning with the Wells Fargos of the world. I mean, they gave you a template. And those guys, a couple of those guys are still at Churchill, right? I mean, that's where those guys were, they were working, under Dash, actually, who's at Redwood, and Ken Logan, who's at Signature Bank now. But they, so it was those guys like Derek and Travis were over there, right? But we were just, it was iterative, and they kept making improvements to the facility, and so you were just really. A big part of the business was liaising, what they were doing on the cap market side to the real world. And that was a big part of how you serviced borrowers, because, look, I mean, at the end of the day, you had a borrower base that was used to these fragmented regional lenders that could operate so quickly, so effectively, so, with such agility that you had to figure out what it was going to take to win them over. And if you didn't have the product to do it, it was an uphill battle. So, I mean, I think a lot of it was organic. And then, when you start a business, you have to make sure that your liquidity landscape's in place. And, so there's a lot of time that's spent on that. But, so I do a lot of that, relative to the day-to-day of it. But look, I mean, this business comes and goes with our clients. I mean, we have great clients. I mean, we have 5 or 6 clients that could be on the show, right? I mean, they're at that level. They're that sophisticated. They're, almost institutional themselves. And by the way, a lot of them, have RTO businesses that are better than ours. But, we've just found great synergies and great partnership when it comes to DSCR and, we'll see how much more we can do on the RTL side with those clients. But, it's been a combination of something that's organic versus something that's real purposeful. And I don't know.
I mean, and that raises another interesting topic, kind of from a capital market standpoint, I guess, is the future of, not future, but kind of where this industry is leading towards when it comes to capital, right? And so, as a capital provider and someone who's studied the market and I consider very well in tune with kind of where capital is and where capital isn't, right? And where smart capital is and where smart capital isn't. This space doesn't have any consistency to capital strategies at all, right? And there's I would say at least 20 commonly used structures out there from mom and pop operation all the way up top. And
yep.
And what's really fascinating is every other aspect of just finance, more of just lending, and even outside of mortgage, has some kind of commonly used strategy. Like in CRE, we see a lot of these debt funds and a lot of these, and they trade with institutions, and there's a lot of institutionality to it. Maybe some securitization or CLO. You don't see a lot of I call TPO programs or correspondence programs that exist in the commercial sector. In non-QM and in consumer, it's the opposite. And so our space has borrowed, I guess you could say, strategies from all different forms of finance and lending. Do you see this space kind of getting towards some type of, I don't know, some type of standardization, or is it just too fragmented for that?
Yeah, no, it's a great point. There's definitely not much standardization. Look, I mean, I think if you look at some components of it, right, take a DSCR loan, for instance. I mean, I would tell you that this is how I would probably frame it, is that in a good market, right, a DSCR loan is somewhat commoditized, right? Mm-hmm. I mean, it's going to go to generally a securitization exit, and, there's rating agency pressure that kind of forms the credit box and so forth. Now, to your point, the origination strategy of the originator is probably completely different because, you're right. Some guys come in from commercial and try to do this. Some guys come in from resi like myself, and some guys come in from capital markets. I mean, you don't know where everybody's coming from. Mm-hmm. And I think that, I think that that's a benefit to the, from an industry perspective. I mean, because look, I mean, borrower experience and client experience isn't one size fits all, right? So, but yeah, no, you're right. I think the one thing that you could possibly see, and this is where you're at the forefront of it, is you've got to realize that some of those other verticals that you mentioned, and generally any consumer related vertical, but, certainly conventional mortgage banking and non-QM mortgage banking, to the extent that the borrower is a consumer, you've got a regulatory environment that has really crammed, those businesses into a pretty narrow operating channel, right? I mean, you can only do so much, and that doesn't exist in our business yet. And, to the extent that you see regulatory pressure heightened, maybe you start to see, more of a, more of a consistency, amongst what people are doing. Because, like, for instance, right? I mean, if you've got to provide, and like on the DSCR side, you still got to provide some disclosures and so forth, right? But if you were in something like, if these loans were, let's say, covered by a TRID, for instance, right? You have to effectively balance your initial estimate, right? Your GFE with your closing, and that takes you've got to have the right operating system to do that. You've got to have the right staff to do that. You've got to have the right leadership to do that, right? And I think that probably could, tweak the DNA of as opposed to saying, hey, look, there's been people who come into this space from the commercial side that have done great, but it could be something like that. But no, I mean, I think that you kind of look at it and you're like, well, you've got these business purpose lenders out there. You've got your client base, like like the funds and so forth that have just, I mean, they could be so agile and flexible and, and they know their markets and so forth, but then you've got like the big non-QM guys who are doing DSCR.
Right. And the way they fund their loans and the way they take care of them is so different. Their borrower experience is different. Their sales process is different. Everything's different. Their borrower
experience and the distribution is completely different. Yeah. Right. So I don't know that anything, forces, this to become universal. I think that
DSCR product is the most likely, if you look at it from a product standpoint, you can kind of see, right? I didn't think of it that way. Like if you look at it from inside of DSCR, there is some level of standardization in operations. You don't see like a DSCR debt fund. It doesn't make any sense to do one, right? But
right.
So like inside in the RTL, you see a common strategy. In the construction, you see a common strategy. And so and multifamily, everyone has a little bit of some kind of standardization in their approach because business needs. And that seems to be a good driving factor. I didn't actually think about it that way. That's a good way to look at it. And I'm really hoping that DSCR is here to stay in our sector and not gobbled up by a lot of these large non-QM shops that seem to have a liking for our space. I don't think it'll happen.
I think it gets back to the distribution, right? Mm-hmm. I mean, at the end of the day, the lenders in this space, and there's a lot of good ones, whether they're institutionally funded or they're not, or they're working with somebody like us. I mean, they know how to service the residential real estate investor. And if you're, if you're offering bank statement loans and recent credit event loans and all these other non-QM offerings, which are all good, by the way, I mean, I just don't know if you can, if you can meet the level of sharpness that some of these business purpose lenders have when they deal with their borrowers, right? Because there's a lot of differences, right? This is a recurring borrower,
the recurring borrower factor is a huge deal. Customer service in this space is
you go about getting that borrower different, right?
Yep.
And at the end of the day, and we've made a lot of investments in technology, a lot of it, almost all of it, based on client feedback, is that, there is a certain analog component to business purpose loans, whether they're DSCR or they're RTL, that I just don't know is ever going to go away, when it comes to the borrower and broker base in this space. And you've seen, look, there's some good technology out there. I mean, you're never going to accuse like a Kiabi of not having good technology, but I bet if you ask, their borrowers or, members of their company, whether or not there's still a big analog component to what they do, they would tell you that there is, right? Because, these loans are just conducive to that. And, I think that's why when, somebody says, well, this non-QM lender's come out and, has this, I would be more concerned about, the competitors, that, attend your conferences, your events, and the events where we all see each other versus a, comprehensive, non-QM shelf. When it comes to market share,
and to make sure I understand what you're trying to say is they don't appreciate and can't comprehend the depth of complexities in dealing with these borrowers.
Well, I wouldn't say that they don't, right? I just think
they can't appreciate it as well as our guys can. I feel like
they're
it's a different world.
They're unlikely to be as efficient, and that's just my opinion, and it's biased. But
so is mine. I agree with you.
And I've got and you get feedback. And by the way, I mean, if you're doing, it takes nothing away from there's tons of great non-QM lenders. Don't get me wrong, but look, if you've got to set up a framework, to deal with consumers, right? You've got to spend time on compliance. You've got to spend time dealing with, regulatory issues, right? So not that you can't develop a good product for the stakeholders in our space, but I don't think I'm not worried about the non-QM lenders coming in and just, taking, all the market share. I'm more worried about, Jeff Tash or Tennyson or some of those guys taking my market share that I compete with every day that know the space, that are great companies, right? So, but look, I mean, to your point, look, they have good access to capital and can price it accordingly, and
very cool.
It's a fair point,
right? So I want to ask you a question, Ben. As president of the company, you mentioned earlier that 70% growth, right? The growing pains over the past 5-6 years now must have been tough. Like, can you talk about that a little bit? Because you guys have grown a lot, and you guys have cemented your reputation in the space, but that doesn't come without pains. And like, how from an operations standpoint, like, how have you guys addressed it? And any takeaways for our listeners to address that as they grow their businesses?
You want me to that's my, no, look, I think one of the things that's been, that I'm super impressed with our team, right, is we've got a low cost to originate, and look, a lot of people know it. Right. We've got a low cost to originate, which ultimately, is something that you can pass through to your client base. Mm-hmm. Look, it's probably not as important generally as the price you're getting from the capital markets, just on a weighted basis, but it's important. So Constructive, we routinely do, 500-600 loans with 95 people. And it's just not, I don't think it's happening. If it's happening elsewhere, it isn't widespread, but no, look, I mean, we've seen times where, all of our queues are backed up and you've got to play damage control. As a matter of fact, when we got into, I'll give you a great example of this. When we got into the first month of our forward, we had gotten into the forward. Basically what happens is we'll set a price with them on the 15th of a month that is effective through originations of the following month. And then we're delivering, probably the third week of the following month. So they're almost extending 2 months worth of, they've almost got 2 months of rate exposure, right? So we ended up getting a really, really favorable price, and the market went the other way like days after. What was interesting, though, is that the rest of the liquidity landscape, and you remember this is probably about March or April, just dried up.
Oh, yeah.
And you started to see participants retrading DSCR loans, 200, 250 basis points at least, or not doing them at all.
Yeah.
But we had this unbelievable price at the time, and we used the first 40% of that to really defensively. I mean, we didn't make a whole lot of money off of that when we probably could have. And we honored everything that we had out there. And I think that went a long way. And, we've used it judiciously ever since. But, there's some other, I think that yes, there's growing pains, right? But it's how you deal with them. I mean, if you go back to March of 2020, we pulled money, there was loans that we were set to fund that we did not fund, right? Now, like I said, we did get a reputation for lending through it because, there were some circumstances that we did fund some loans, but we went back and paid, it cost us about $500,000. We paid brokers to reimburse borrowers for earnest money. We paid out broker fees. We had ran a damn contest in March of 2020 for brokers. And some of these guys, by the time the third week rolled around where everything kind of stopped, they had already hit thresholds that would have got them paid. We paid them all.
Mm-hmm.
So when you're kind of going through things like that, I think you just have to, there's times where your queues are backed up and your locks get, expire. And look, I mean, you need to take care of your client base at that point in time, whether it's not economically favorable or not. So yeah, we've dealt with them, but the other thing is that we've got, if you look at our leadership team, I know that, that Tess has spoken on some of your panels sometimes, and she runs the operations here. I mean, she's at Morgan Stanley 25 years. I mean, so yeah, are we doing a lot of units at Constructive? Sure. But, I think that, a lot of it is that if your leadership, stays focused, and look, you got to make some decisions that aren't necessarily favorable at the time, but I think that's how we deal with it.
Mm-hmm.
But yeah, our queues do get backed up. I mean, and generally it's when we get a little bit of an arb on price, and the market realizes it very quickly. It's amazing actually how quickly the market realizes it.
Mm-hmm.
Look, you focus on your clients first, and your margin second, and you're probably it makes dealing with those types of things and decision making and process pretty easy.
Yeah, I mean that's
usually
it's a massively important thing that a lot of people forget, right? They let their bottom line dictate everything, and the bottom line is going to shrink if you don't take care of customers and you don't take care of your clients, take care of your people, right? So, agree with that. Cool. Well, I want to transition to our little more fun questions that we have prepared, and they're a little more easy. So we always ask these of our guests. And so I want to ask you the first one. What was your very, very first job?
Oh, my first job was caddying. Yeah. And it's funny because I needed a better agent or something, because what I pay the kids now is, egregiously
caddying on a golf course.
Oh yeah.
Okay.
Yeah. Caddying on a golf course. But I mean, I used to carry bags for, $22 for 18 holes. These guys now, I mean, I'm paying these kids, 5x that.
Right. Was it very common when you were young? Because the caddying thing kind of went away on the West Coast before I started.
Yeah. So I grew up actually in suburban New York City in Westchester County.
Okay.
Which is, look, I mean, there's no shortage of private golf clubs there. It's probably a good way to explain it.
Mm-hmm.
So no, I think it was common for, kids in high school to caddy at the local club, and, kids to come back even from college and caddy at the local club.
Right.
So,
right. It's a good way to make some nice money that way.
It's always been big. We have a good program at our club in suburban Chicago too. I mean, but yeah, that was my first job. I ran with that one for a while.
Did you learn anything at this first job that you still use today?
I would say if I had to answer it, I would just say just high level. Look, you're relating to successful, intelligent people. And you hope you pick something up from that, but I probably can't think of anything directly.
No, but I got
stronger.
Open, right?
I got stronger carrying 2 golf bags around. I feel like.
Oh man, that's a lot of golf clubs. Okay, next question is there any business tool that you use that you just cannot live without?
Doesn't exist.
Doesn't exist.
That doesn't exist. I'd figure it out. Look, I'm not good with technology anyway. As we were obviously trying to set we were to set up the meeting. No, there's nothing. No.
All right.
If you wanted to, if we needed to run Constructive with fax machines, like we would do it. Like
figure it out. All right. I like that.
Yeah,
I like that. And then last question, just so we can get to know you a little better. When you're not out, when you're not running Constructive and being that leader of the company that you are and watching capital markets, what do you do? What do you do in your own personal time?
Yeah. So, I play a lot of golf.
Okay.
And my family, my mother took up golf at 72. My wife plays, has, historically played over 100 rounds a year. And my daughter, who's 14, is a very, very good competitive golfer. Actually has a future at some level. So I play a lot, right? So, and then the other thing is I work out quite a bit. I mean, it wouldn't be uncommon, in Chicago, it's May through October probably, where, I might run 40 miles a week and play 3 rounds of golf, in a given week.
Wow.
And that's probably just to keep me sane, right? Because like I feel like the weather in Chicago now, my golf game and the 2022 mortgage market probably have a lot in common.
I can appreciate that. Yeah. Yeah. Hey, if it keeps you sane and you love it, and it
must be cold. It must be cold in SoCal because you're not in a short sleeve shirt.
No, yeah, it's cold. I actually have a coat here. And speaking of golf, it's been raining for the past 2 weeks, so no one's playing. Yeah. All the courses are closed because when we get rain, it floods on the courses because they don't have good drainage because they don't think about water.
Right.
So and they're scared of lightning strikes, so they don't let anyone on the course because we never get rain here. So, but otherwise, 11 months out of the year, it's fantastic golfing. But we don't have caddies, so that's one thing we don't have out here.
Yeah, that's weird. I mean, who knows? The California labor laws, you'd probably have to. I don't know.
That's probably the reason why. We have a lot of car valets here. A lot of kids valeting cars, but we don't have any golf courses, even private ones with caddies. And I kind of wish they did because that's
weird.
Yeah, I played in Asia, and they all have caddies, and those ladies will teach you the best way to approach the hole, and they tell you exactly how to play after they figure out how you play, and it's so useful. So anyway,
I just think it's good for the kids. It's just good for the kids to develop a network, right? I mean, if you
learning personal skills that are coming back, to be able to talk to people, it's not easy.
Connections. I don't know.
Yeah, if they had that when I was a kid, I probably would have done it, but they don't. Yeah, not here in California. We don't get that. All right. Well, Ben, it's about that time to wrap down the podcast. Thank you for joining us. It was really fun.
Yeah, no, I enjoyed it a lot. It was good to catch up. We'll have to figure out the next time we're going to see each other. But
exactly.
I definitely enjoyed it. So thank you for having me.
Thank you, Ben. All right. For all our listeners, thank you for listening to this episode of Lender Lounge with Kevin Kim. See you on the next one. Wow, that was a great episode, wasn't it? Hey guys, don't forget to put your Apple Podcast comments and 5-star review. You're going to be entered into a contest to win a pair of Apple AirPods. So please do so. Let us know how you feel about the show, and we want to hear your feedback. Thank you very much. This is Kevin Kim. Thanks for listening to Lender Lounge with Kevin Kim. I hope you enjoyed this episode as much as I did. If you did enjoy, please leave us a 5-star review on your podcast platform, and be sure to follow our show to be notified of new episodes. If you're on YouTube, don't forget to smash that like button and hit subscribe for more content from all of us here at Jurassic. Lender Lounge with Kevin Kim is available on all podcast platforms. Referrals really help us spread the word, so please send this over to someone you think might enjoy it. See you next time. This is Kevin Kim, signing off.